Welcome to Griffonomics. Imagine you buy a massive, sprawling business, right? And your very first move to make it more profitable is, well, you immediately fire a huge chunk of your customers.
Right. Yeah.
You shut down dozens of your own factories, and you intentionally produce, significantly less product.
Yeah. I mean, to a casual observer, that just sounds like an absolute recipe for bankruptcy.
Exactly.
But in the world of heavy industrials, shedding that dead weight and intentionally shrinking your volume is sometimes the only mathematical way to survive and, to actually grow your cash flow.
And that counterintuitive, almost ruthless strategy is the exact mission we're looking at today. Because if you're looking at a balance sheet and you see a company actively turning away revenue, your first instinct is probably to panic.
Oh, absolutely. It's terrifying for an investor.
Right. But here's what you might be missing. Today, we are unpacking a highly granular strategic roadmap on one of the largest, most complex corporate integrations in the world right now. We're talking about the massive merger of Smurfit Kappa and Westrock.
Yeah, now operating as the packaging behemoth, Smurfit Westrock.
Exactly.
And it is a phenomenal case study in deep value turnaround. We're basically watching management try to execute this high wire act on a global scale.
Yeah.
They're fundamentally changing the operating culture of these legacy American assets to match a highly disciplined European model.
The ultimate question we are trying to answer for you today is simple. Is this giant integration a value compounder like a machine that will quietly print cash for a decade, or is it a friction trap that's just going to collapse under its own weight and burn capital?
Which is a very real possibility.
For sure. So to figure that out, we are digging into their Q1 2026 forensic data, this fascinating concept they call the Smurfitization of North America, the timeline for $800 million in synergies, and their incredibly audacious 2030 medium-term plan.
Right, the one targeting $14 billion in discretionary free cash flow.
Exactly. Okay, let's unpack this. Because to understand where Smurfit Westrock is going by 2030, we first have to look at the immediate bleeding mess they are cleaning up in North America right now.
Yeah, and the Q1 2026 numbers reveal a pretty stark divide within the company. I mean, if you look at the forensic breakdown, the North American segment is severely lagging.
It's bad.
It is. They posted a 13.3% margin, which translates to about $597 million in adjusted EBITDA.
And just as a quick reminder, that's essentially the raw cash profit from operations before taxes and accounting depreciation.
Exactly. Now compare that 13.3% to their EMEA and APAC segment, so Europe, Middle East, Africa, and Asia Pacific.
Okay.
That global segment delivered a much healthier 15.2% margin.
Wow. So that is a 190 basis point margin gap.
Yes.
In plain English, their North American operations are nearly 2% less profitable on every single dollar coming through the door compared to their international counterparts.
Right. And when you're dealing in billions of dollars of volume, I mean, a 2% gap is a massive leak in the boat.
It's huge. And that gap led to a rather ugly headline, right? A 19% EPS or earnings per share miss for the quarter. And Wall Street hates an EPS miss.
Oh, they despise it. And that headline number triggered some immediate sell-offs. But if you are rigorously analyzing this business, you have to separate structural decay from temporary noise.
Okay, so what was the noise here?
Well, that 19% miss was heavily influenced by freak occurrences. For instance, the North American segment absorbed a massive $55 million impact purely from severe weather events.
Just weather.
Just weather, freezing up supply chains in January and February. And on top of that, they suffered $74 million in downtime costs across their mill network.
And half of that downtime was completely unpredictable, right?
Right.
I remember the CEO, Tony Smurfit, specifically highlighted a massive electrical cable failure near one of their major mills.
Yes.
A vital piece of infrastructure just snapped, causing a multi-day power loss. And it's like, you can build the best financial model in the world, but you can't really model for a catastrophic cable failure.
You really can't.
Yeah.
Which is precisely management's argument to investors right now. They're insisting that this Q1 volatility is largely transitory. It's just weather and bad luck.
Right.
The real story, the structural story, is how they plan to permanently close that 190 basis point margin gap.
Yeah.
And that brings us to their core integration strategy, heavily referenced by analysts as the Smurfit way.
The Smurfitization of the legacy Westrock assets. I absolutely love this concept because it goes against traditional corporate bloat.
It really does.
Essentially, they're taking Smurfit Kappa's historically high-efficiency, decentralized owner-operator model and actively forcing it upon the underperforming U.S. mills.
Yeah. And to understand why this is necessary, you have to look at how legacy Westrock operated. They had this massive system that prioritized volume above all else.
Just keep the machines running?
Exactly. Keep the machines running, keep the boxes shipping, even if the profit margins on those specific boxes were razor thin or, honestly, non-existent. The Smurfit way aggressively flips that. It prioritizes value over volume. They're pushing decision-making down to local plant managers, putting them through rigorous operational training and ruthlessly pruning high-cost, inefficient business from the network.
The numbers on this pruning phase are wild to me. They aren't just tweaking things. They are taking a chainsaw to the asset base. I mean, they have already taken their loss-making North American box plants from between 60 and 70 all the way down to just 29.
It's a huge reduction,
Yeah.
and the physical execution of that is fascinating. They provided a very specific facility example to prove this decentralized model works.
Oh, I saw this in the deep dive sources.
Yeah, so they took one legacy Westrock plant that was historically producing 350 million square meters of packaging volume, but it was losing $20 million a year doing it.
Losing $20 million while producing that much, incredible.
Right, so they brought in the Smurfit operational team, empowered the local manager to basically fire their lowest margin clients and optimize the floor.
And what's the result?
Today, that exact same plant is producing only 280 million square meters. So a massive drop in volume.
Yeah.
But it is generating a $15 million profit.
That's amazing. It's like pruning a massive overgrown apple tree. You violently cut away the dead branches, and yes, you end up with fewer apples overall, but the fruit you do get is significantly bigger, healthier, and actually edible.
That's a perfect analogy.
But here's where I have to push back a little. If you are actively shrinking your footprint by cutting volume, literally shedding paying customers, how do you keep Wall Street happy? I mean, institutional investors usually just want to see top-line revenue growth every single quarter. They want the chart to go up and to the right.
Yeah, what's fascinating here is that shedding uneconomic business is the exact discipline that drives actual free cash flow, rather than just vanity metrics.
Okay, right.
Wall Street might have an initial knee-jerk reaction to declining top-line revenue, but what they ultimately reward in a deep value turnaround is margin expansion and cash generation.
Because top-line doesn't matter if you're losing money on it.
Exactly. If you're running massive industrial machines to produce millions of boxes, but you're losing 2 cents on every single box, you aren't a healthy business. You're just a very busy, capital-destroying machine.
Yeah.
Smurfitization is about stopping the destruction of capital.
That makes a ton of sense when you frame it around capital preservation. But pruning bad box plants in North America is just one piece of a much larger global puzzle. Because if management is going to hit their massive $800 million synergy target by 2027, we have to look across the Atlantic at how they are rationalizing their legacy assets in Europe.
Right. And this brings us to what management refers to as Wave 2 of the synergy realization timeline.
Okay.
To give some context, Wave 1 was the initial merger integration. That brought in the first $400 million in synergies, primarily captured through SG&A savings, which is selling, general, and administrative expenses.
Basically corporate overhead, redundant software systems, overlapping executive roles, combined procurement power.
Exactly. They've already achieved that.
Right, the low-hanging fruit of any merger. I mean, you don't need 2 HR departments.
Precisely. But Wave 2 is the harder operational phase. This isn't just firing redundant accountants. This requires deep, systemic, physical optimization of the manufacturing base.
Stuff that hurts.
Yeah. In Q1, they commenced specific consultations to optimize their European system, which involved permanently closing 4 smaller converting operations across the UK and the Netherlands.
But the massive move was the paper mill in Birmingham, UK. I mean, they announced formal consultations to shut that enormous facility down completely.
Yeah, the Birmingham mill is a perfect example of integration friction. It had a substantial production capacity of 200,000 tons of paper per year. But as the CEO explained, it was one of their absolute highest cost facilities to run.
Wow.
And more importantly, it had what they described as the wrong width for the long term.
Let's clarify what wrong width means in this context, because paper mills aren't just big warehouses, right? They are continuous manufacturing machines. If the width of the giant paper roll coming off the machine doesn't perfectly match the modern specifications of the box plants it feeds, you end up having to slice off the edges. and that creates vast amounts of trim waste.
Yes.
And retrofitting a massive ancient machine to a new width often costs more than just building a new mill from scratch.
That is the exact mechanical reality.
Yeah.
It simply wasn't economically viable to upgrade it to modern standards.
Here's where it gets really interesting. Is shutting down a 200,000-ton paper mill really a synergy? Or is it just cutting your losses on a bad asset and masking it with corporate speak?
That's a fair question.
I mean, at what point does all this integration friction, closing plants, laying off workers, paying severance, start burning morale and cash faster than it actually saves?
That is the core tension of any major M&A turnaround, and it's a completely valid concern. But true optimization requires painful people change and ruthless capital reallocation.
Right.
Think of capital tied up in an inefficient, high-cost asset, like the Birmingham mill, is dead weight. Every dollar spent subsidizing that mill's high operating costs is a dollar stolen from a high-performing asset.
So it's an opportunity cost.
Exactly. By shutting it down, they take a short-term financial hit on severance and closure costs, the friction, but they permanently stop the bleeding. It builds a structurally sound foundation for the long term.
Okay, I follow the logic of stopping the bleeding. But you can't just cut your way to growth indefinitely. If they are aggressively shedding bad volume in the U.S. and permanently closing entire mills in the U.K., how are they fundamentally replacing that revenue? Because eventually you have to grow.
Absolutely.
And this brings us to their commercial innovation engine.
And this is arguably the most exciting growth driver for them. They have a major initiative called Better Planet Packaging that is aggressively targeting a $10 billion total addressable market for plastic-to-paper substitution.
$10 billion in potential revenue, just from convincing consumer brands to replace plastic with paper.
Yeah, and they're developing highly specific product lines for this. Things like Evergrow, which replaces plastic punnets for fresh produce.
Oh, like the little plastic baskets berries come in.
Exactly. And paper-based beverage multi-pack carriers designed to completely replace those plastic rings and shrink wrap you see in the grocery aisles.
Okay, let's pause and look at the actual engineering here, because standard cardboard gets soggy. How are they realistically replacing plastic shrink wrap in a damp grocery store refrigerator without the six-pack just falling apart in your hands?
That's the primary engineering hurdle, and that's why this isn't easily replicated by smaller competitors. They aren't just using standard corrugated board, they are heavily utilizing highly specialized paper grades.
Like what?
Specifically, solid bleached sulfate and coated unbleached kraft.
Which, stripped of the industry jargon, essentially means highly treated, moisture-resistant, tear-proof premium paperboards, like the kind of structural material that can sit in condensation for a week and still hold the weight of 6 glass bottles.
Exactly. It has to withstand high humidity and extreme tension. And they've already successfully converted over 250 million units to these specific substrate-agnostic materials.
That's wild.
But the real brilliance here isn't just the physical engineering of the paper, it's the sales strategy.
The experience centers, I was reading about this in our sources, they have built 33 global experience centers. It's like a high-end test kitchen where clients get to taste the recipe before they commit to buying the whole restaurant.
It really is.
Clients come into these physical labs, they see the capabilities, and they work directly with structural designers to build custom, sustainable packaging for their specific product.
And the metrics prove that this hands-on approach is working aggressively. Through these centers, they successfully onboarded over 600 new corrugated customers in Q1 alone.
600 in one quarter.
Yeah. That is exactly how you replace the uneconomic volume you purposefully shed in North America with high-margin, sticky clients.
And let's be honest about the underlying motivation for these clients. Smurfit Westrock is actively easing the burden of regulatory compliance for these major global brands.
Oh, 100%.
Walking into a massive beverage company and saying, hey, Europe just banned your plastic rings, let us make you legally compliant by Friday, is the ultimate sales pitch.
It is the strongest possible leverage in a B2B sales environment. Now, this commercial innovation is happening globally. But if we want to see what the entire company might look like by 2030, there is one specific region where this Smurfit model is already running at absolute peak efficiency.
Oh.
It serves as the operational blueprint for the rest of the world.
You're talking about the Latin American segment, the LATAM gem.
Latin America is the undisputed crown jewel of their portfolio right now. In Q1, on just $500 million in net sales, they delivered $109 million in adjusted EBITDA.
Wow.
That translates to an operating margin of 20.2%. They consistently print margins hovering around 20% in this specific region.
Wait, if North America is struggling at a 13.3% margin, how is Latin America casually printing 20%? What is their actual structural moat down there?
Their moat is built on two unshakable pillars: immense regional scale and extreme vertical integration.
Vertical integration meaning they own the whole process.
Exactly. They are the only true large-scale pan-regional packaging player in Latin America. But more importantly, they own the raw materials. They own the vast majority of their 308,000 acres of forests and plantations in that region.
So they literally own the trees.
They own the trees, they own the pulp mills, and they own the box plants.
So when global pulp prices skyrocket, their raw material cost stays essentially flat because they are just buying from themselves.
Precisely.
That is a massive competitive advantage. And they just actively expanded that footprint. They acquired a major corrugated box plant in Ecuador during Q1. But what caught my eye in the integration reports is that this wasn't just a geographic land grab.
Right.
They're planning to supply that new Ecuadorian plant with raw paper directly from their North American mill system.
Which perfectly demonstrates the strategic value of their newly combined global footprint. They can leverage the excess paper capacity they have in North America and ship it south to feed these high-margin converting operations in Latin America.
But wait, I have a hypothesis I want to test on this global supply chain.
Okay, let's hear it.
If LATAM is printing 20% margins and Europe is sitting at 15.2%, why was Latin America suddenly buying raw paper from Europe at heavily discounted prices earlier this year? How does that dynamic actually benefit the whole company?
If we connect this to the bigger picture, it reveals the sheer speed of global export arbitrage. For a brief period, European consumer demand was unusually soft, so European paper mills had excess capacity.
And you don't want to shut them down.
Exactly. Slowing down massive paper machines costs a fortune. So they kept them running and dumped the excess paper into Latin America at a steep discount. But Tony Smurfit noted that this global dynamic shifted almost overnight.
What?
Suddenly, European paper capacity tightened back up, order lead time stretched from weeks to months, and those discounts completely vanished.
Meaning Latin America suddenly needed a new source of cheap paper.
Correct. And because they have a highly integrated global system, Smurfit Westrock can pivot their supply routes on a dime. They instantly swapped to utilizing North American paper for that Ecuador plant.
That's incredible.
This global agility allows them to optimize their internal costs regardless of where regional bottlenecks pop up.
And the ability to pivot like that is absolutely critical right now because the macroeconomy just threw them a massive, unpredictable curveball.
The sudden demand spike paired with severe structural cost inflation.
Exactly. Tony Smurfit explicitly said that consumer demand shifted so radically entering the second quarter that almost all paper grades were left in an effectively sold-out position. Their order books just surged completely out of nowhere.
Which sounds like phenomenal news to an investor until you look at the raw cost side of the ledger. Industry profitability was actually plummeting right before this demand spike because of severe inflation.
Yeah.
The CFO, Ken Bowles, revealed a massive, unexpected energy cost spike. They are now facing a $270 million to $290 million energy headwind for the year just to keep the machines running.
That is hundreds of millions of dollars above their initial internal estimates. Plus, they're eating another $50 million headwind, just increased freight and shipping costs.
So to combat this massive margin squeeze, they had to aggressively flex their pricing power. In North America, they implemented containerboard price increases of $50 per ton.
And another one's coming, right?
Yeah. A second $50 per ton increase was announced for June. So that is $100 per ton in total hitting the market.
Yeah.
In EMEA, they implemented a €100 per ton increase for recycled paper.
But, and this is a crucial but that trips up a lot of casual observers, there is a standard 3 to 6 month time lag before raw paper price increases actually translate into revenue in the corrugated box segment.
This is a fundamental mechanic of industrial contracts. When energy or freight costs spike, say, natural gas prices jump, Smurfit Westrock has to pay that higher price immediately today to keep the factory lights on. The cost hits their balance sheet instantly.
But they can't instantly pass that $290 million cost onto the customer because they are locked into long-term vendor agreements.
Precisely. Most of their major corrugated box contracts have a built-in 90 to 180-day review period. The contract dictates that, yes, they can raise prices based on market indexes, but only after that lag period expires.
Wow.
So they announce the price hike in the spring to cover their energy costs, but the actual cash from that hike doesn't hit their bank account until autumn.
So if I'm looking at this, they are forced to swallow a $300 million margin squeeze for an entire quarter, just sweating it out and bleeding cash until those customer contracts finally roll over.
That's the reality, yeah.
That perfectly explains why retail investors might panic in Q1 or Q2 when they see the margins compress, completely missing the tidal wave of legally locked-in cash that's coming in Q3 and Q4.
Exactly.
But how does management survive that lag without institutional investors demanding a change in strategy?
Well, surviving that short-term optical margin squeeze is exactly why their executive compensation and long-term capital allocation frameworks are structured the way they are. Management is actively forcing the market to look past the 2026 friction and focus entirely on their 2030 medium-term plan.
Ah, the 2030 plan. Let's look at these numbers because they are staggering. They're targeting $14 billion in cumulative discretionary free cash flow by the year 2030.
This is massive.
To get there, they want to hit $7 billion in adjusted EBITDA with a 19% group margin, representing a highly ambitious 7% compound annual growth rate.
It is an aggressive target, but it is designed to mathematically assure investors that the core cash generation engine of the company remains completely intact despite the current noise.
Okay, give me an example.
Take their dividend, for example. It currently yields around 3.6%. Despite all this messy integration friction, the plant closures, and the Q1 weather hits, the combined company still generated $1.5 billion in adjusted free cash flow.
In 1 year.
Yeah. That purely organic cash flow proves the core dividend is incredibly well protected while they compound value over the next 4 years.
And management's own wallets are tied directly to this cash goal, which is always the best indicator of intent. Looking at their proxy statement, a massive 35% of executive bonus compensation is strictly tied to free cash flow generation.
That's a huge chunk.
And another 10% is tied directly to hitting those specific synergy targets we discussed earlier.
They're also taking steps to streamline their corporate structure, including reviewing their listing on the London Stock Exchange and potentially delisting.
Really, delisting from the LSE.
Yeah. It is a strategic move to reduce ongoing operational complexity and regulatory costs. It aligns the corporate entity with where the majority of their shares actually trade and removes administrative friction.
So what does this all mean? Tying 35% of executive bonuses to free cash flow generation proves they mean business. But if I'm playing devil's advocate, with so much heavy capital still required to fix and upgrade those 29 North American box plants they kept, is that $14 billion cash target a realistic promise? Or is it just an aspirational carrot dangled to keep Wall Street patient during a very messy turnaround?
This raises an important question about the fundamental tension in any turnaround story. It's the brutal battle between required capital expenditures to fix broken machines and the generation of discretionary cash flow. Fixing those North American plants will undeniably require significant upfront investment. But consider the alternative. The fact that they have already successfully extracted $400 million in Wave 1 synergies and are showing a willingness to ruthlessly shed their deepest loss makers suggests the heavy lifting of the capital drain is being actively managed.
So they have a track record of actually doing it.
Exactly. If the European owner-operator model holds in America, the cash will inevitably follow the efficiency.
Which brings us to our final verdict. Based on this granular deep dive, is Smurfit Westrock a value compounder or a friction trap? They recently reaffirmed their €5 billion to $5.3 billion EBITDA guidance for 2026. Given the surging energy and freight costs we just outlined, is that actually achievable?
Based on the structural data, yes, it is highly achievable. But it hinges on two strict requirements. First, the Smurfitization of North America has to continue yielding margin improvements. And second, those $100 per ton price increases must successfully flow through the delayed customer contracts in the second half of the year.
The 3 to 6 month lag.
Right. If those contracts roll over as legally required, it perfectly times a massive earnings acceleration for Q3 and Q4. In that broader context, the Q1 EPS miss truly was just temporary noise driven by bad weather and a broken electrical cable.
And if you were looking at this balance sheet, the key takeaway is classic deep value investing logic. The messy integration phase, all this integration friction with mill closures, severance payouts, and contract time lags, is exactly where the opportunity lies. You have to look at the math before the rest of the market sees the perfectly cleaned up, highly efficient balance sheet in 2027.
It requires looking past the construction dust to see the structural integrity of the foundation they're pouring.
I want to leave you with a final thought to mull over as we wrap up. If Smurfit Westrock successfully Smurfitizes their legacy North American assets and actually hits that 19% global margin target by 2030, they won't just be a packaging company.
No, there'll be something much bigger.
Given their sheer scale and vertical integration, they will effectively control the operating system for the world's physical supply chain. I mean, almost nothing moves globally without a corrugated box.
That's very true.
What happens to the smaller regional packaging players when a $14 billion cash flow giant decides it wants their market share next?
That is a very daunting prospect for any competitor hoping to survive the decade.
Until next time, risk defined, portfolio protected.